Okay, so let's get started. We're going to go over options trading, and it's going to be more of a beginner's type options trading session. And this was yet another session that you guys, as a group, recommended that we go over because it's something that you guys wanted to learn about, or maybe get into, or at least check out. So that's why we're doing this particular session today. So let's start with what is an option. An option is basically it's a financial contract that gives you, the buyer or the investor, the right but not the obligation. Very key there. The right but not the obligation to buy or sell a stock at an agreed upon price at an agreed upon date. And this is kind of why it's called an option, right? Because you have the option to buy it if you want to, but if you don't want to, well, that's okay too, right? So one of the big differences between an option and a stock is with options, you can lose 100% of your investment, right? And that's pretty unlikely on a stock because, for you to lose 100% of your investment, the stock has to go down to $0 for that to happen. And that, typically doesn't happen, as we know. But with options, that's not the case. You can lose 100% of your investment. And we'll get into that a little bit more here later. So, because of that, because you can lose 100% of your investment, whereas with a stock purchase, you typically can't. Why do traders like to trade options? Well, because it gives them leverage, right? So just like with a margin account, where you're borrowing money to take a position, which multiplies the power of your capital, right? Gives you more buying power by using margin. Well, same thing here with options. Options give leverage because they allow a trader to multiply the power of their capital, right? And we'll go over why. So how does that happen? How in buying an option, how does that give you leverage? Well, so when you're buying one contract of one options contract, let's say, that gives you control of 100 shares of the stock, right? So you can basically control 100 shares of a stock at a fraction of what it would cost you in capital to control the same amount of shares if you just purchased the shares outright. The cost of an options contract will be lower than the cost of the underlying stock, in other words. So let's look at one example just for clarification. So let's say that you're willing to make a trade today and you want to use $1,000 of your capital on that particular trade. So let's say you're interested in a company named Passing Gas Oil Company. It's kind of a trader joke there. because you're interested in it because you think that it's going to go up. Let's say it's currently trading at $30 and you believe that the stock price is going to go up to $35, right? So you could purchase the stock with your $1,000 capital, and it's currently trading at $30 a share. So that would give you the opportunity to buy 33 shares, right? Let's say that you're looking at the same idea, that you think that Passing Gas and Oil is going to go up to $35. So let's say that you buy a $35 call option. And that current call option is trading at $2, right? So each contract is going to cost you $200 because you have to use that multiplier, right, times 100. So each contract is going to cost you $200 and give you control of 100 shares per contract, right? Well, with your $1,000, instead of only buying 33 shares, you can buy 5 contracts, right? Which effectively gives you control of 500 shares instead of only those 33 shares for the same capital of $1,000. So hope that makes sense. So that's where you get the leverage. As far as your broker goes, most brokers will have different tiers for playing options, okay? Obviously, each broker is going to differ. Tier 1 may be just trading basic options. Tier 2 may be trading option spreads. Tier 3 may be shorting options, right? You would just need to check with your individual broker to see how that works, which tier you need to qualify for based on the type of option strategy that you're interested in trading. Okay, so let's talk about some different components of an option contract. So we're not going to go over all of the different components. We're not going to go over everything today simply because we will not have time. But by the end of this session today, you'll have a pretty good foundation of what options are and how they work. We will certainly build on that in sessions to come. So you have calls, okay? And buying a call option, it's basically you're buying options based on your thoughts that the price will increase in the future above your strike price, okay? Buying puts, that's buying options based on your thoughts that the price will decrease in the future below your strike price, right? Or it will stay below that strike price. Now, buying puts, is obviously bearish. You're bearish on that particular stock, right? Or at least you're bearish on it at that strike price. But it's different from a short position because with a put option, your risk is limited, right? So your risk is only 100% of what you invested. Whereas when you take a short position on a stock, we all know you have unlimited risk, right? Because the stock could just go up and up and up on to infinity. Whereas with a put, your max risk is whatever your investment is. Okay, so let's talk about strike price. So what is a strike price? The strike price is the agreed upon price should you, the investor, choose to exercise the option to convert that to shares. Okay, so if you had one option contract that got you the option to purchase 100 shares at your strike price at that particular expiration date, then you have the option to convert that contract to 100 shares of stock. So the expiration date, that's pretty obvious. There's an expiration date for options, and unlike a stock, options have an expiration date. That's pretty self-explanatory there. Some traders will sell the option as it increases in value based on price action. If it's going up for a call or down for a put, and never exercise the option. And I would say that the majority of traders never exercise the option. And we'll go over a little bit of that here shortly as to why. Some traders scalp options, some traders short options. You can short a put, you can short a call. And we'll go over that in more detail in later sessions. So as we talked about before, one call option gives the investor the right to purchase 100 shares of the stock at the strike price, right? At whatever on or before the expiration date. One put option gives the investor the right to sell 100 shares of the stock at the strike price on or before the expiration date. The option contract multiplier, so let's say that you're looking at a stock and looking at an option, and you see that the option price at the whatever option that you're looking at, that the price is $3. Well, when you buy that particular contract, you have to remember that the option contract multiplier, it's times 100. So if the option price shows $3, to take one option on that, it's going to cost you $300, okay? Make sure and keep that in mind. You're going to see in the money, at the money, and out of the money. So what do those mean? So in the money means that the stock that you're currently looking at is trading above your strike price on a call or below your strike price on a put, right? So in the money, so whether you have the option or not, in the money just means that whatever call option you're looking at, if it's in the money, that means it's either trading above the strike price on a call or it's trading below the put price or the strike price on a put. At the money just means that the stock is currently trading very close to that strike price. So if you have a strike price of $50 and then another strike price, the next higher strike price is $55, and you have a stock that's trading at $53.96, so your next at the money would basically be the $55. Hope that makes sense there. Out of the money just means that the stock is currently trading below the strike price on a call or above the strike price on a put. That means it's out of the money. So those are the three differences there. We talked a little bit about it costing you money to purchase a call. We talked about a minute ago that if a call option showed $3, that it's actually going to cost you $300. Why is that? What is an option premium, and why do we have to pay that, right? Well, the option premium is the cost to have that right, okay? To have the right but not the obligation to exercise the option. So let me give you an example of why we have to pay that. So let's say that I'm just making up something in my head here. Let's say that you wanted to purchase a piece of land, okay, just outside of some major city, all right? Because in about a year, you want to build a house on that land. You're not ready to do that now. You don't really have enough money to do it now, but you know that in about a year, you'll have enough money and you'll be ready, right? So, but you want to take advantage of the current price of the land, right? Because you believe that it's only going to get more expensive over the next year, right? So let's say that the piece of land that you're looking at is $100,000, right? And you don't want to pay the $100,000 now. So what you do is you buy a call option on that piece of land, right? So that will give you the right to purchase that land at any time between now and a year from now for $100,000, right? You don't have the obligation to purchase the land, only the right to purchase the land if the value increases, right? Well, that'd be a pretty good deal, right? You're at zero risk, right? So obviously there has to be something given on your end. So this is, unfortunately, we don't get that without a cost to us, basically. And this is where option premium comes into play, okay? So you must pay a premium for that right, and it makes perfect sense, right? So let's say the premium to have this option to purchase this $100,000 piece of land, let's say the premium is $2,000, right? So the strike price in this case would be the $100,000, and the expiration date would be the 1 year from now, right? And the premium would be the $2,000. So just kind of breaking it down, that's kind of a layman example, but just wanted to give some clarity on that, just to give an analogy. So let's say that if 8 months from now, the current value of the land is now $125,000, right? So this puts you obviously in a very favorable position because you can exercise the option at any time and purchase the land for a bargain price of $100,000, even though the current value is $125,000, right? Or you can sell this option to someone else who is interested in owning the rights of that contract, right? Which is what most traders do. Most traders are not looking to purchase that land, right? They just want to make money off of the increase or decrease, if you're on a put, in the value of the underlying security. Hope that makes sense there. So let's say on the flip side, if you waited the full 1 year for the expiration date, right, to see what the value would end up being on the piece of land, and it actually decreased in value. Let's say that now, today, instead of worth $125,000, now it's only worth $75,000. Maybe something bad happened in that area, and now the value of the land is only worth $75,000. Well, then your contract is actually worthless, okay? Because why would somebody want a contract to purchase that land at $100,000 when they could buy it just straight out for $75,000? So that's why whenever you get to expiration, if you are, out of the money, basically your contract is worthless. So you or anyone else will not want a financial contract with the right to purchase a piece of land at $100,000 when it's only currently worth $75,000, right? So at this point, the option contract would expire worthless, and you would forfeit your option premium of $2,000. So that's where you would lose your premium. Okay, so typically most traders, like we talked about a little bit before, most traders are not looking to ever exercise their option contract. They're merely looking for an increase in the value of that option contract and then sell it for a profit prior to the expiration date, okay? And you can sell your option contract at any time you like prior to the expiration date. You don't have to wait until expiration. in other words. So basically, you're looking to sell your option at a high premium, or at a higher premium than what you paid, right? So this is done by the price increasing from when you bought it for a call, or decreasing from when you bought it for a put. So the benefit is the leverage, right? We talked about that. So, if you had purchased shares, you may only see a 5% increase on the stock price, whereas on that same exact movement on the stock, you might have a 15% increase in the premium of the option when you purchased it. All right, so this is where that leverage comes in. So you can see a much higher percentage return from options than you can from the underlying stock. So it leverages your profit if you're correct in your assumption of what the price was going to do, of course. And this is another reason that traders, like options, of course. So we talked about in the money, out of the money. So let's talk about a couple of other important components. Let's talk about intrinsic value. So what is intrinsic value? So you have intrinsic value and extrinsic value. So let's talk about intrinsic value first. So intrinsic value is basically the value of any option that any option would have if it were exercised right then, like exercised today, at that moment. What would the value be? So if you have a call option that you purchased, let's say at a strike price of $20, and the current price of that stock is $25, well, it would have an intrinsic value of $5, right? And the opposite is true for puts, of course. If you had a $20 strike price and the stock is currently trading at $15, then you would have an intrinsic value of, again, $5, right? And when you buy regular shares of stock, you only lose money if the stock price goes down. This is not the case with options. With options, you can actually lose money even if the stock price stays the same. And people are probably asking, well, how's that, right? Like if you buy Apple at whatever price, let's say, $200, and it goes down to or it doesn't move at all, it just stays at $200, well, you haven't lost any money, you haven't gained any money, but you haven't lost any money either, right? Well, that's not the case with options. With options, you'll actually lose money over time if the price stays the same. And let's go over the reason why. So the reason why is extrinsic value, okay? Some people refer to it as time value. So what is that? What is extrinsic value? So basically, extrinsic value or time value, it's the option's potential to become more valuable prior to expiration, right? So basically, if you have a call option that expires in 30 days, there is time value in that. It could, at any point in time during the next 30 days, increase in value, right? With that said, the longer the expiration date is out, the more time value it has. Therefore, it will cost more premium. Being in that particular part of the premium is in the extrinsic value, right? The more time value it'll have, therefore it's going to cost more premium, and because it has that chance to go up or down at any time during that time period prior to expiration, right? So it could see a significant upside or downside depending on if you're talking about a call or a put, right? So that's the extrinsic value, okay? So because of that extrinsic or time value, even if the stock price remains the same over a given number of days, your contract will actually lose its value because it's losing its time value, right? As your contract gets closer and closer to expiration, you're losing that time value. Because think of it like this: if you have an options contract that expires in 30 days, you have a lot better chance of during the next 30 days that the price could make a significant move up. Let's say it's a call option. Anytime in the next 30 days, yeah, you could see a significant move up. Whereas if your contract expires tomorrow, what are the chances that it's going to have a significant move up in just one day or 24 hours or 12 hours or whatever? So I wanted to point that out. So basically, as you get nearer to your expiration date, the less of value the contract will have because of that time value. And a lot of people refer to that as time decay. And basically less time for the stock to move in a significant direction. So a little bit more on time value. So let's say that you have that same strike price, let's say $20, on a call option, but you have two different expiration dates, right? One expires tomorrow, and let's say the other one expires in 3 months. Well, you're going to pay much less premium on the if they're the identical call, okay? The identical strike price. You're going to pay much less premium on the one that expires tomorrow, because the likelihood of the stock running up another 5, 10, 20 bucks or more by tomorrow is less probable than it increasing by those amounts over the next 3 months, right? So basically, it's less likely to increase the implied volatility, which we'll go over in the intrinsic value. It's less likely to increase the intrinsic value by those amounts in that short amount of time, basically. So we know that by this, that if the stock shoots up a significant amount very quickly, you stand to make more money because you still have good time value left, as well as the increased intrinsic value, right? So, you're not, let's say that you bought a call option today, right? And then let's say it's a 30-day call option, and it's 30 days out for expiration, and then tomorrow it just rockets up. Well, you're going to make a lot more money on that particular call option than you would if that had happened 3 weeks into your trade, right? Because now you still have almost all of your time value, all of your extrinsic value is there, as well as you have that intrinsic value from when the stock jumped up. Hope that makes sense there. So So time decay. Think of it like a countdown timer, basically. It starts as soon as you purchase an option contract, and this timer will slowly count down towards $0 of value as it nears the expiration date. That doesn't mean that you can't still make money, because you can still make money on the intrinsic value. It just means that your extrinsic value is going to decline over time. All right, so let's talk about implied volatility and what that is. So implied volatility is it's included in the extrinsic value. First, let's point that out. Basically, it is what the stock price's fluctuations are expected to be. Okay, so the more volatile a stock is, the more implied volatility it will have, and thus it will make the premium higher, right? So larger price swings are expected, basically. So, and this is based off of the high to low trading range of a stock over a specified period of time, right? So, and I'll give you maybe an example here in just a minute of that. So within a given amount of time, because of the volatility, an option on a stock that is very volatile, right, it has more potential to become significantly intrinsically valuable, right? This is why you'll see, Tesla options. They typically have a significant premium because they're so volatile, right? Tesla, as we know, can move a couple of $100 just in a span of a few days or a week. So because of that, just like AMC was back when, or GameStop was back when that whole ordeal was going on, that thing was so volatile, and so was AMC. So that's why those options, they were expensive, because they had a lot of implied volatility. So keep that in mind when you're looking at stocks. The more volatile that stock that you're looking at, the likelihood that the more premium you're going to pay on an option. Okay, and basically the changes in an option's extrinsic value, the time value, right, which is where implied volatility is loaded, okay, is in the extrinsic value. Due to buying and selling pressure, that causes the implied volatility to change, right? So basically what I'm trying to say is that the changes in prices of options is what drives the changes in implied volatility, okay? Not the opposite. Implied volatility does not drive changes in the options. The options prices change, it drives the change in the implied volatility. Just want to make sure and point that out. So, and you can make a profit from implied volatility alone, right? Just like you can with intrinsic value alone, okay? So if you purchased an option today for, let's say, a premium of $5, and there starts to be a lot of call activity, right? They're being purchased just like crazy, and the stock increases in implied volatility, even if the price doesn't move, right? The price gets, so let's say that you had a strike price of $20, and the price of the stock was trading at $21, and the price hasn't changed. It's still trading at $21, but because it got more volatile, and you don't have any time decay because you just purchased that option, then you can still see the premium of that option increase due to the increase in implied volatility, which puts you in profit right away. Hope that makes sense. And you can also lose money, of course, if the reverse happens, right? If you get into a stock with high implied volatility, and then all of a sudden the volatility lowers, that's going to lower the extrinsic value, and then you're going to lose money, even if you stay at the same price. These are all things to keep in mind when you're looking at options. There's a lot more to options than there is to trading a stock, as I'm sure you can tell by now. So we talked about earlier, most traders don't ever exercise their option. They don't wait until the expiration date and exercise their option. Why is that? So let's go over why that is. So when you exercise an option, you'll gain the intrinsic value, right? So let's say that you bought a call option at $100, right? And at expiration, the stock price is now the strike price was $100, and now the stock price is $125. Well, you have $25 intrinsic value, right? So your contract is worth money, right? It has intrinsic value at the expiration. So the problem with that is if you exercise, then you lose any existing extrinsic value, okay? So let me give you an example. So let's say that you owned a call option of a stock at a $50 strike price, okay? And the stock is currently trading at $55, right? So if the current call option price that you paid or is $10, okay, you pay, let's say that the call option price is now $10, okay? That's a premium of $1,000 because you have that the times 10 or modifier, right? Or times 100 modifier. So you're looking at an option price of $10, so that's a premium of $1,000, right? So you have $5 of that, since it's $5 above your strike price. So $5 of that is intrinsic value, and the rest, so that's $500, right? And then the rest of the $500, which is the rest of the premium, is extrinsic value. So if you were to exercise that option, you would be able to basically purchase 100 shares of that stock, right, which is trading at $55 a share. And let's say this is even way before expiration. Let's say that you're not at expiration, which is why it has that extrinsic value still. So you were to purchase 100 shares of a stock. You have the right to do that at $50 because that was your strike price. And the stock's trading now currently at $55, right? So you'll have a value there of $500, but you're going to lose your $500 extrinsic value, okay? Because once you exercise, you don't get that extrinsic value, okay? So your exercise value basically is going to be the 100 shares of the stock at $5. That's going to give you $500 profit. If you sold that same contract, if you didn't exercise and sold the contract, well, you're going to see the intrinsic value as well, which is $500, and you're also going to get the $500 of extrinsic value. So that gives you $1,000 profit instead of $500 profit. Hope that makes sense. This is why most traders do not exercise their options. They don't go to expiration. They don't exercise them prior to expiration. Basically, most options traders are merely looking to profit off of the increase of premium or increase in premium for that option, and rarely, if ever, exercise. I'm sure there are some that do that, but most of them are not doing that. Okay, that's all I have here. Basically, we're going to go over more in our next options session. As you can see, there's a ton of information to cover, and it just can't be done in one session without making the session just astronomically long. We'll go over open interest, what happens, what does getting assigned mean? We'll go over shorting calls and shorting puts. We'll go over how to actually buy an option and all that stuff. We'll also go over, looking at the options chain and what all of this stuff means, and time and sales for options. There's just a lot of information that we need to go over or to continue on, and we'll do that in a future session. So I hope that was helpful for everybody. I'm going to open this up for questions now. Stop the recording here.